Hello and welcome, everybody. Welcome back to Sectors Made Simple. Today, we are continuing our conversation about the asset class cycle and different types of assets that are part of it. We're going to be talking today about one of the inflation-sensitive assets, commodities, and we're going to take a look at how we can invest with them. Before we get into it, quick disclaimer, everything today is not meant as a recommendation to buy or sell anything and is meant as an educational resource. There is a lot that goes into commodities, and the point of today is to share that information with you to help you make more informed investment decisions. But with any type of investment decision, remember that past results cannot guarantee future performance. So, we're going to dive into commodities. And before we do, I want to quickly mention, if you're watching this webinar live with us on YouTube, thank you so much for joining us. This is a recorded webinar, so unfortunately, I will not be able to see your comments or answer your questions, but our community is still here to take care of you and make sure that if you have any questions live, we can answer those. But if you have any questions or you're watching this recorded, you can always send me those questions over at support@sectorsmadesimple.com. All right, let's get into what we're going to cover about commodities. We're going to start off basic with what commodities are and the different types of commodities or the groups of commodities that are available to us. Then we're going to take a look at how commodities generate returns or profits and losses for investors, and the difference between two of the main types of commodities: physical commodities and futures commodities. Then we're going to take a closer look at what different factors go into the price and the price direction of these commodities, and why and where these commodities sit in the overall economic and business cycle, from both the perspective of buying them and selling them. And then we're going to wrap things up by talking about how we can invest in commodities directly, and as a quick foreshadowing, how you are probably already invested in commodities directly, as well as how we can invest in commodities indirectly. Let's get into it. Let's start off from the very beginning. What is a commodity? The simplest answer, it's stuff. Commodities are just different types of stuff. But to give you a better answer, they are raw materials that are used to run the economy and produce all of the different goods that we know, love, and buy. These can range from everything such as gold, to wheat, to oil, and even coffee. Commodities are very, very different from other types of investment, both in how we can invest in them, but also how they work. They don't generate earnings. There is no single wheat company that we can go out and buy. Wheat as an idea, as a product, doesn't have company earnings, earnings per share, and it doesn't really pay interest. All that we have is the price of that commodity and its largest driving factor, supply and demand. How much wheat is there, and how much is someone willing to pay for that wheat? Let's do a quick example. We're going to use the example of oil, specifically heating oil, or rather in this case, crude oil. We'll come back to heating oil later on. But here, we're going to talk about crude oil, raw oil, and the unit of measurement for it, a barrel. At the start of November of 2025, a barrel of crude oil costs around $70. This crude oil is used to make lots of different oil products, but the main one would be the gas that we put into our cars and airplanes, but also oil that goes into heating many houses, especially on the east coast of the United States, where it gets pretty cold in the winter. Now, let's take an idea of where we are in November. November is a month with a very large US holiday, Thanksgiving. This is a holiday that is famous for bringing family together from all areas to come, enjoy a dinner together, and spend some time together. That means that people are going to drive to go see their families. If they're far enough away, they are going to take a flight to go see their families. But also, it's November, and chances are it's pretty darn cold in many places in the United States, which means those houses are going to have to be heated to keep everyone nice and cozy. All of these factors, driving, that's gas, that's crude oil. Planes, that's gas, that's crude oil. Heating our homes, that's heating oil, that comes from crude oil. You're starting to get an idea of how these different events are going to lead to increased demand for oil. And as a result, crude oil prices are going to go up around the holiday. This is mostly noticed in November because it's cold. It is a holiday that is cold. Christmas, similar deal. But it's going to happen with any holiday. And we're just using oil as an example here. This same idea applies for almost all commodities. They will have times that they are higher in demand, as opposed to other times where they are lower in demand. But before we dive too far into different examples of commodities, let's talk about the entire world of commodities and the different commodities that are often traded by investors. An easy way to think about these commodities groups is to think about it like the stock market and market sector. We have 3 or 4 groups / sectors, depending on how you want to look at it. We have energy, we have agriculture, and we have metals. Sometimes this group metals can be split up to industrial metals and precious metals. But within each one of these groups / sectors, we'll have individual commodities that we can think of like companies. Energy will have things like crude oil, gasoline, and natural gas. Agriculture will have wheat, corn, soybeans, sugar, coffee. And precious metals will be gold, silver, and platinum. And industrials are more things that are used in manufacturing like copper, lead, and nickel. So we're starting to see how it's a wide range of different stuff. Some of them are things that we grow. Some of them are things that we pull out of the earth. But in all of these cases, these are materials that are going to be used by someone or something and then work its way into the economy. So, of course, with any type of investment, we care about its returns. How does a commodity actually generate returns for an investor? We mentioned earlier, commodities do not have earnings, it is not an individual company, and they don't really pay dividends, there's no interest, it's not like a bond, not like a company. It is very unique. There's not a fixed number of shares. How much of a commodity there is in the market is just determined by how many people are pulling that thing out of the earth. For wheat, it's how many farmers are farming wheat. For oil, it's how many countries / companies are pulling oil out of the earth. They're created either by Mother Nature, well, actually, in all cases, Mother Nature. So they are created, extracted, and then shipped and sold to different companies or end consumers with the goal of being used. But where's the profit here? A bushel of wheat is kind of hard to think about as an investment because it's grown by a farmer, sold to a baker that turns it into flour, they bake it into bread, and then sell the bread. Where's the opportunity for investors? Well, the silly answer is it's like any other type of investment. We're buying a thing and we want to buy it low and sell it for a higher price. It's not focused on interest payments. It's not focused on some quantifiable return like we would see from dividends. It works a lot more like a stock. But instead of trading a small piece of a company, we're trading physical goods. But here's the interesting part. A company, the majority of a company's value is future value. That's why we have something like earnings per share. Price to earnings ratio. My apologies. The price to earnings ratio looks at how much profit a company is generating, earnings, and compares it to the share price. So if we say that the S&P 500 has, on average, a price to earnings ratio of 30, what that means is for every $1 of current value profit, investors are paying $30. That's a big difference, which means that a good part of a stock's current price is not based on what the company is worth today. It's based on what it could be worth in the future. That has a much smaller part in commodities. There is still future value, but it's not based on an idea that the company is going to keep growing and growing and growing. The future value here is based on the thought that demand is going to increase. People are going to need more of this stuff in the near future, so I'll buy it now, wait for demand to go up. When demand goes up, prices go up, and then sell it for the higher price. But again, that future value is limited. It is a much smaller part of the price of each commodity. A lot of the value of that commodity is based on what it is currently worth, its short-term future value, its price over the next few months to years, or year rather, but also what someone else is willing to pay for it right now. So let's take a closer look at the supply and demand. Because as I mentioned, that is the big driving force behind price changes. Yes, we talked about the economic cycle and the business cycle and the asset class cycle. But putting all that aside for a moment, that asset class cycle is going to talk about supply and demand. Sometimes in that cycle, there's going to be more demand for a product than there is at another point. And again, that is the main factor that impacts the price of different commodities. If there's more supply and less demand, prices are going to go down. There's too much stuff, too many people selling, and not enough people buying. So the prices are going to go down until there is a happy point where people are both buying it and selling it. How about the other side? Less supply, but more demand. Now, there's not enough of this supply to go around and for everyone to be happy, so the price is going to keep going up, and fewer people are going to want to buy it until we find the point where there's enough supply to meet demand. But let's jump forward here and ask the biggest question, and we'll kind of answer it right now. How can I invest in a commodity? Because I don't know about you, my backyard doesn't have land to grow a bunch of wheat. But what happens if I want to invest in wheat? I definitely don't have oil sitting in my backyard. How can I invest in oil? There's two main options. Buy the commodity physically, or buy a futures contract for that commodity. Let's take a look at both. Starting off with the one that's a little bit easier for us to think about and understand. Physical commodities. This could exist for any commodity. In practice, not really something that makes sense. Because physical commodities means that you physically own that commodity. If you're invested in wheat, that means that you own wheat. You have wheat. You are buying and selling that commodity. Now, let's use a sillier example. Oil. There is nothing stopping you from investing in oil and going out to the market, buying 5 barrels of crude oil, and then shoving them in the garage. You think your family gives you a hard time about all the random boxes you have sitting in the garage or the car that doesn't run anymore? Theo Frank, I'm looking at you. Imagine if you had 5 barrels of crude oil, and these barrels are not small, by the way, just sitting in your garage. Sure, it's a good investment, but the family's probably not going to be too happy about a bunch of barrels in the garage, and your neighbors might look at you a little bit funny. So, probably not something that makes sense for investors. But there are other types of commodities that aren't barrels of oil, like precious metals. Do you own a gold necklace, a silver necklace, or a bracelet? Any piece of jewelry made from a precious metal? The answer is probably, right? That's technically a commodity. You own the gold commodity. Now, you're not going to be sitting on kilograms of it. It's not in a big brick, but that gold has significant value. Right now, the gold price is around $5,000 per ounce of gold. There are places both that you can go to physically or places online where you can buy and sell gold. And of course, that place is going to take a cut. So if you are trying to sell your gold to someone buying it, you're probably only going to get 80 to 90% of that market value. But it doesn't need to be a brick. You can go take your jewelry to a pawn shop or to a gold or precious metals dealer. And what they'll say is, okay, it is this type of gold. This is how much weight you have in actual gold. Here's how much we'll pay for it. Are they going to keep that piece of jewelry? Probably not. But these metals can be taken, melted, and then made into new jewelry, put into contacts for electronics. Gold is used in many different places in the world, both to manufacture stuff, but also as products like jewelry that we buy. Now, you didn't buy that gold necklace thinking about it as an investment. Maybe you did, but most people don't. They buy it because it's a piece of jewelry that they like and that they want to wear. But it's very helpful to think about and remember that it is both. It is a nice piece of jewelry that you can wear right now, but it is also a physical commodity that can be bought and sold by investors. So by owning that piece of jewelry, you are technically invested in a commodity, that commodity being gold or silver. Then there's the rest of them, which mostly are traded, and by people like you and me, almost entirely traded through futures contracts. This is how the majority of commodities work. Partially because it's silly to just have a bunch of barrels of oil sitting in your garage, but also because a big company is not going to want 5 barrels of oil. They're going to want 5,000, 50,000 barrels of oil. So now we're dealing with bigger numbers. So a futures contract is one of the main ways that many commodities and most commodities are traded. A futures contract is a contract. It is an agreement and requirement to trade a certain amount of commodity at a certain period or date in the future for a set price. By buying that futures contract, you are buying that commodity at that price. It is not an option to exercise it. It is you will buy this thing if you are owning this contract at the end of its trading term. That commodity will then be delivered in the future. Where? Depends on the contract. Each contract will control a certain amount of that product. Let's do a quick example. We're going to use the example now of heating oil using the New York Harbor ULSD futures. And the one we're going to focus on for this example is the closest one to us, April 2026. Here's what that means. This is a contract for barrels of heating oil for a delivery in April of 2026. And that contract has an expiration of when it's no longer traded, and it is now, I will deliver this to you. You own this contract, it will be delivered to you. That trading ends on the last business day of the previous month, which in this case, for an April delivery, would be March. So, March 31st, whoever owns this contract at the end of the day now owns a bunch of oil. How much? 42,000 gallons. Hope you have a pretty big garage. And I hope that garage is in New York. And the current price as of March 5th, 2026, $3.55 and 99 hundredths of a cent. Specific, right? Now, let's do a little bit of math. 42,000 gallons at a price of, let's round, $3.56 per gallon. That's $150,000. That's pretty darn expensive. But that doesn't mean you need $150,000 to buy that contract. Instead, what happens is these contracts are bought on margin. Margin, pretty advanced topic when it comes to investing. You're investing with someone else's money. They're guaranteeing that you're good for it. There's a lot that goes into margin and not something we're going to cover today. In fact, there are many reasons why specifically for commodities we're not going to cover margin. But the important thing for us to know here, we're not paying $150,000. We are paying some small amount of that. So maybe $20,000. But let's take a quick step back. We've got margin. We've got contract units. We've got expiration dates. We have contracts at all. And we have the idea that we're paying a small amount of money to control a large amount of stuff. That ring you any bells? Because it might. Sounds a lot like an option, like an options contract. So let's compare them. We're going to look at a bunch of different parts of a futures contract and compare them to an options contract. An option would be the option to exercise that contract on or before the date. Futures are a requirement to trade that commodity. An option, it can expire and you don't need to do anything with it. And if it expires worthless. A futures contract, when that futures contract expires, congratulations, you're now the proud owner of 42,000 gallons of heating oil. Options almost always control 100 shares of a specific company. Futures contracts will depend on the specific type of contract we're looking at. For wheat, it could be 5,000 bushels. For oil, it could be 42,000 gallons. Each type of commodity, each type of futures contract will have its own set amount of units that it controls. An options contract can be exercised at or before expiration. So if you have a options contract that expires at the end of the month, and it's profitable to exercise it right now, you could exercise it. You could use that option, claim those shares. Futures contracts, that doesn't work like that. It is settled on the last day of a month, and then it's delivered in that following month. You can't exercise it early. It is an agreement to buy a bunch of physical stuff, not a digital promise to make when it comes to buying or selling some shares. Now we start to get into some more of the technical, super complex stuff that most of us don't care about, but are still important to know when it comes to comparing options contracts and futures. An options contract can be traded in many different types of investment accounts, provided you can trade options in there. It could be a standard brokerage account, a cash account, or even a margin account, and are traded at the price of that option. That option price, some small percent or some small amount compared to the actual number or value of the shares that it controls. In either case, though, you would need to apply and be accepted to have permission to trade options in that account. Futures contracts can only be traded in an approved margin account, and those trades are made via margin, not cash. We're not trading $150,000 over some oil futures. We're probably trading $20,000 or so. So whoever that broker is, you have a margin agreement with them, and you're using that margin to actually buy and trade these different futures contracts. And then finally, options contracts are written by investors. It is a contract written by someone and sold to the market. And when that contract is honored, they are the ones that would pay it out. Futures contracts are standardized and listed by the specific exchange that they're traded on. So, similar idea. Both are contracts, both control something more than the value of that contract, and everything beyond that point is completely different. And just to kind of show you something funny, options are what are known as a derivative investment. They are an investment of an investment. Futures contracts, they are the investment themselves. And that means that they can have their own derivatives. There are options for futures. Head starting to spin? Don't worry. The idea behind futures is that we're dealing in big quantities and big numbers. Because again, this is not really a world built for individual investors trying to figure out what to do with their brokerage account. It is a way for large companies and organizations to buy and sell significant amounts of product on an open marketplace. And it also sets a standard for what the price of those goods should be. So when you're making a side deal with somebody, you're going to agree on some price. What price do you start with? Well, it depends. If you want to go and buy a used car from someone, you guys don't know what the fair price is. So you're going to go and look at what other cars have been sold, see what their condition was, see how many miles they had. And you're going to look at those and then start to discuss a price from there. So both individual transactions and these large listed trades or contracts are going to kind of be connected. But why? Why do commodities deal with these crazy ideas of futures? Well, I kind of hinted at it a little bit, but the most obvious answer, commodities are things. Somebody pulls that thing out of the ground and creates it. They sell it to somebody that uses that thing to create something else, something more advanced. And then, now that commodity's been used. If it's gold and they're making a bunch of headphones, for example, at the end of your headphone, it has that little point. If you have headphones with you right now, unplug it and take a look. There's a very good chance that it's going to be yellowish orange, because it's probably gold plated. There's a little bit of gold there because gold is a great metal for conducting electricity. It doesn't corrode. It doesn't have many issues that other types of metals do. And that makes it very popular for electronics, both small and big. So we've taken gold out of the ground, we've turned it into raw gold, and then that gold has been used to make something, jewelry or electronic parts. But let's do another example. Wheat. Wheat is grown, that wheat is harvested and then stored, and then shipped and sold to someone else, stored again before it is finally processed and used. There's two important parts here. The idea that it is grown and it is sent somewhere to be processed, that's the trade. That is where a futures contract would come in. The person that is growing that wheat, they're going to use a futures contract as a way of finding a buyer. That contract will say when it needs to be delivered, at what price, and where it needs to be delivered. Then the rest is out of their hands. So working in futures contracts lets businesses find customers, but also lock in prices, where now it's a lot easier to know how much are you going to sell that wheat for. You know the price. The price is in the futures contract. And it makes the monetary side of trading goods a lot easier. There's one other example that I want to give here that covers the second part of this chain. And this actually happened in the past. Storage. Wheat is grown and then stored. It is sold and then stored before it is used. It is possible because futures contracts, as the name implies, talks about something in the future. There have been times that storage is the problem, that there's nowhere to put the stuff that is coming out of the ground. And in that case, that means that there's way too much supply and not enough demand. There was a point in the past couple of years where the price of oil barrels went negative. Oil producers were paying companies to take the oil because they ran out of places to put it. Their need to get rid of their supply was way higher than demand, to the point where they were paying people to get rid of it. So futures contracts are crazy. You're dealing in trades that have not happened yet, and that can lead to prices going up a lot or going down so far that they can become negative, depending on how quickly or how much someone needs to buy or sell what they have. But now we're starting to get into the idea of what determines the prices of different commodities. And I mentioned the big one, supply and demand. But there are a bunch of smaller ones as well, like seasonality. Let's think back to one of the first examples that we did with oil and Thanksgiving. Seasonality is the idea that at different months of the year, There will be things that are doing better or worse. Let's think oil. Oil is typically used to heat homes, which means that when it's colder, there will be more demand for oil. So in the winter. But in the winter, you can't really grow a lot of stuff. Places are too cold, crops don't grow as easily. So now, those crops will have higher supply in the summer, lower supply in the winter, but we still want our bread. So something like wheat would probably have higher supply, lower demand in the summer, lower supply, higher demand in the winter. And that's another reason why futures contracts are so great. They let businesses make deals for up to a year in the future. Let me show you an example. If we look here at our oil contracts, we can go in and we can see the different dates where there are contracts all the way up to January 2030. Are they being traded? Not really, but there are contracts for every month of the year, which means a company that knows it will need a bunch of oil for the winter can stock up earlier in the year when prices are a little bit lower. But here's the big one. We know now that commodities are typically sold as futures contracts. And as I just hinted at, this allows commodity consumers to lock in the prices for those future deliveries. Supply is high right now, and demand isn't. So a company that knows they're going to need some oil in the future is going to buy a bunch of futures for that month, and then know that that delivery will come through that month. But that's for the consumers. For the investors, they're going to try and predict all. They're going to try and think what might be needed in the future and try and predict the supply and demand of those goods and profit off of those shifts, both due to the economic and business cycle, but also global events and conflicts. We're going to use an example that is happening right now. What you see above me here is the price of a gallon of heating oil, presented by the same New York Harbor ULSD. By the way, if you're curious why it says New York Harbor, that's the port of delivery. That's where those barrels of oil will be delivered, or gallons of oil in barrels will be delivered. But take a look at the chart above me. And I want you to notice something. We see a spike in November. That's Thanksgiving. But let's see what's happened in 2026. Because currently, this gallon of oil, of heating oil, is selling for $3.56 per gallon. And at the beginning of 2026, a gallon was just around $2.10. What happened? Why the increase? It's not because supply has changed very much. Not that supply is now ridiculously high. Or sorry, the opposite. Where supply is ridiculously low. Instead, demand is extremely high because fears around oil are extremely high. What started the increase? Why at the beginning of 2026 did the price of oil start to go up? The US attacked Iran. The US attacked Iran, and Iran is both an extremely large producer of oil, a member of the largest organization of oil producing countries, OPEC, and they have a place right next to one of the most important shipping routes in the world, the Strait of Hormuz. Obviously, conflict with an oil-producing country that sits right next to and can cause problems with global shipping routes is a big deal. So, we saw the price of oil go up to around $2.60, $2.65. Things calmed down a little bit until they didn't. And let's actually go to that chart together so we can look at it almost day by day. February 26th, $2.30. 27th, $2.31. And from March 2nd to March 5th, it's gone up over $1, almost over 30%. And today, by the way, it is up 5.2% again. Why? Well, the United States started what they call Operation Epic Fury, and they attacked Iran, took out a lot of the leadership of Iran, and in return, Iran has threatened both the United States directly and shipping routes through the Strait of Hormuz. They have threatened to attack ships going through that channel, and they are trying to use their power, their place in OPEC to fight oil shipments to countries like the United States. Has current supply changed? Not really. In fact, the supply of heating oil has actually gone up. So it's not a case of supply is now extremely low. That supply has only gone up, but everyone's terrified about what's going to happen with the prices of oil, how long this conflict is going to go, how serious Iran is about hurting trade. So everyone's trying to stock up. Everyone is trying to lock in those really good prices because we don't know how bad things are going to get and how expensive a barrel of oil might become. So that fear is driving up the prices of futures contracts for April and later. That's the interesting thing about these futures contracts. They are agreements to buy something in the future, and demand, if there's uncertainty, is going to skyrocket because everyone wants to get that order in right now. This is, albeit an extreme example, like if we look back in time, this happens every so often, like 2022, for example. But it's not something that happens all the time. And it goes to show us two things. One, there is a lot of craziness that happens when it comes to different types of commodities. They change in price very quickly, which makes them very interesting to traders that want to trade short term. If the prices will move due to things like global change, global issues, the savvy investor can try and predict those changes or bet that they think they know what's going to happen and profit as a result. But here's the other one. You see this massive increase from 2021 to mid-2022 before cooling back down again? Let's think back to what was happening then. Inflation was skyrocketing. And then in mid-2022, inflation started to go back down. But many people and economists were asking the question, are we in a recession? Are we entering a recession? Is the economy shrinking? So, another big part of this is sensitivity to inflation. And that is what we saw in 2022. Inflation went up. And as inflation went up, the price of oil went up. The commodities went up. As inflation started to go back down, because now companies are not making as much profit, the economy is starting to shrink, demand will go down, and the price of the commodities went down as well. Which means we know inflation matters, which is why commodities are one of the two asset classes that we'll talk about in the series that are inflation-sensitive investments. They are traded globally, but they're often priced and traded in US dollars. So when the dollar rises through inflation, commodities can become more expensive. That's exactly what we saw in 2022. But also, rising inflation will lead to rising interest rates from the Federal Reserve. When interest rates rise, it makes it harder for companies to borrow money. They're going to stop growing. Their share prices are going to go down. Their profits are going to go down. They're going to lay people off. That is how the economic cycle works. And of course, part of that is decreased demand for commodities. When demand decreases, commodity prices decrease as well. Let's now put commodities in their place in the economic cycle, and we'll use Pring-Turner's 6 stages of the business or economic cycle, where we see commodities appear twice, not by name, but by their group, inflation sensitive. First, we see them in stage 3, where they are typically bought, and then sold in stage 6. Let's take a look at why, and apply what we've learned about commodities to this cycle. Starting with stage 3. Stage 3 is known as the early expansion period. We've just come out of a recession, and the economy is starting to grow again. And because we just came out of a recession, inflation is pretty darn low, at one of its lowest levels we'll see. But investors might begin to fear that inflation is going to go up because growth is happening. Growth is happening, there's more economic activity, more money going into the economy, companies are hiring, companies are building new things. That building, that increased production, that increased consumption, all of that is raising prices of those commodities. Some physically backed commodities, like gold and silver, are both consumed during this expansion, but also are typically bought because they are slightly lower in price right now. They're seen as safe places to put money if and when economic activity begins to slow down. But futures contracts also will raise in price because demand is increasing for those commodities to fuel the new growth that is happening. Now, companies are going to try and purchase those commodities before inflation begins to rise again. So things like gold and silver become investments because we're worried inflation is going to go up. And futures contracts become a valuable investment because the demand for those commodities is going to go up. And then later on in the cycle, the economy has gone up, stopped, and starting to decline because inflation is high and interest rates have risen to try and fight that inflation back down. Economic activity slows, the demand for both physical commodities and futures decreases, and of course, with that decreased demand, prices are going to drop as well. 2022, perfect example of that. During this period, we saw the GDP of the United States, how much stuff we were producing, going down quickly. Was it enough to say that we're entering a recession or in a recession? Depends on who you ask. But from commodities, if you asked commodities, they would have said the economy is shrinking, and we see what happened to all of the commodities prices as that was changing. So, what will happen is before that decline begins, investors are going to try and sell out of commodities to keep all of the gains that they'd created and take all of that cash and prepare for a recession, where it's very difficult to find areas of the market or investments that are providing strong returns. But recessions clear out old stuff to create room for new growth. And then, as the cycle begins once again, we start to see our asset class cycle reset and the 3 different stages of buying begin again. So that is the place that commodities have as an inflation-sensitive investment and where they are in the asset class cycle. Let's wrap things up by talking about how we can invest in commodities both directly and indirectly. Starting off with directly. This can either be extremely difficult or extremely easy, depending on what type of commodity we want to buy. Let's just talk futures contracts. Chances are, you're probably not going to watch this webinar, run out, and open up a margin account to trade futures contracts. Chances are, you don't want to deal with the special account and all of the crazy risks and thoughts that have to go into figuring out supply and demand changes, cyclicality, seasonality, and of course, global events. But that doesn't mean that you can't trade you can't trade future contracts. This means that we're probably not doing it directly. Physical commodities, though, different story. As I mentioned, you are probably already doing this, not because you're thinking about it as an investment, but because you have some things that are gold or silver. Those gold, silver, platinum pieces of jewelry, while they are jewelry and they are things that will have value to you, they do, as raw materials, have significant value to the market as well. A gold buyer can buy gold, melt it back down into raw material, and either sell that raw material or turn it into a different piece of jewelry and be both the buyer of the commodity and the processor of it, and then selling the final good as well. More realistically, though, we're probably going to invest in ETFs, because ETFs exist for both physically and futures-backed commodities. And just like with stocks, there are a lot of choices when it comes to picking the right ETF. What commodity is it, and how is it backed? Physical or futures? But also, this is something that we see with stock ETFs, which is leverage. You can buy an unleveraged commodity ETF. If the price of gold goes up by 5%, that fund goes up by 5%. But leveraged ETFs also exist. These funds offer higher risk and higher reward. For example, we could see terms like ultra, or 2x or 3x. Let's take 2x for an example here. If you see a 2x leveraged fund, what that means is for every 1% price change in that commodity, that fund will go up or down by 2%. More risk, more reward. This also means that there is a lot more opportunity for even shorter term trading of different commodities. Yes, they have their place in the asset cycle, but as we saw with what's going on right now, what happened in 2022, that's the asset cycle doing its thing. What's happening right now? Global event. There is an opportunity for an investor that wants to take advantage of investing with current events to trade on these oil contracts through an ETF and increase the risk and reward through a leveraged fund as well. Also, there are inverse funds. These will be inverse/shorted. And the thing about these, we'll see it as inverse, short, or bear. With an inverse fund, when the commodity goes down in price, the ETF would go up in price. So if we had a short fund or a bear fund, if gold went up by 1%, the fund would go down by 1%. And whenever we're saying this, by the way, it's always on average. That's the goal. Past results don't guarantee future performance. Reality is not as pretty as a textbook. So it's not, we're always going to see up 1%, down 2%, and so on and so forth. But typically, their goal in an inverse fund is to go in the opposite direction of the commodity. Because if the commodity goes down, for example, let's say right now you think that all of this conflict is going to end tomorrow, and the price of oil is going to drop back down to $2.50. You can capitalize on that. You can profit off of thinking it's going to go down by buying an inverse fund. So when the price of the commodity, in this case oil, goes down, the price of that fund would go up. Here, we'd be looking for terms like bear, short, or inverse. And it is possible to find funds that are both leveraged and inverse. We'll see those terms combined. Bear or 2x bear or ultra short. Those are going to be leveraged and inverse. A great resource for finding and comparing ETFs would be ETFDB's ETF screener. We can find that on etfdb.com. And in the menu, go to Tools, ETF Screener, and under the asset class on the left side, choose Commodity, and then the type of commodity that we're interested in, not bond. On the screener, we can then filter out things like leveraged ETFs or inverse ETFs under attributes. And a few things to consider when deciding between them would be things like their expense ratio. Typically, inverse funds or leveraged funds are going to have much, much higher expense ratios, above 1%. The type of commodity, obviously. If we're interested in buying something like, if we're interested in trading, for example, the short-term price swings in oil, you're not going to buy a wheat ETF. You're going to buy an oil ETF. So the type of commodity will matter a lot. And if we can't decide between a few that do similar things, that's where SMS can come in. Over on our custom matrix tool, you have the ability to go in there and compare different ETFs through their current prices using relative strength. Before we wrap things up, let's go quickly and take a look at ETFDB's screener together. We're going to go to Tools, ETF Screener. On the left side, we're going to go to Commodity, and we see that there are 86 different commodity ETFs for us to look at. The nice thing about this screener is that we can see the different breakdowns. So there are 23 energy. There are 4 industrial metals, 30 precious metals, most of them, by the way, gold. And we can also see the type of fund, like what are they invested in, futures or the material itself. We go to physically backed. You're going to notice something immediately. Every single one of these ETFs that is tracked by this tool are precious metals. While there probably are, and there are precious metal ETFs that trade in futures contracts, physically backed are going to almost exclusively be precious metals. If we look down this list, let's just choose energy, for example. Let's see what we have. USO, oil fund. UCO, ultra. Okay, probably leveraged. Is it? Survey says 2x daily leverage. And let's compare something. USO, expense ratio here, the annual fee that they charge, 0.6%. Ultra, 1.43% per year. So yes, 2x the risk and reward, but also 2x and then some the expense ratio. And if we scroll a little bit further down, oh, hey, look, ultra short. Give you a good idea of what that one is. 2x daily, 2x leverage, inverse. So when oil goes down by 1%, this will go up by 2%. Great when oil's not doing well, a little rough when it is. Ultra short once again. You're starting to get an idea that we will see many different types of funds. And if we don't want any of that, on the left side, we can go here and we can go to attributes, my apologies. And we can go here, instead of leveraged, we can go to false. This will give us funds that are not leveraged at all. So that is an overview of commodities. There's a lot going on, and honestly, more than we probably care to deal with. But that doesn't mean that we should ignore or be afraid of commodities. While they are sensitive to short-term changes due to global events, so are companies. One company has a bad earnings report, yeah, that price is dropping. The difference here is that we are not dealing in trying to guess the future value of a company. We are dealing with physical things that are bought, held, consumed, and then sold. These are materials that have real value, and what we are actually buying and investing in is the supply, demand, and current need and future need for those goods. They have their place in the asset cycle for mid to long-term cycle-based investing, but also there are opportunities through both traditional non-leveraged ETFs, but also inverse or leveraged ETFs to short-term trade based on changes that you think or believe might happen in the near future. But I want to thank you all so much for joining us for this webinar. Again, if you have any questions, you can always send me an email at support@sectorsmadesimple.com. And we'll see you all back next Tuesday for the final part of the series where we are going to cover the other type of inflation-sensitive security, TIPS. Hope to see you all then. Take care. Bye.